Today we're looking at the Blackrock ASX200 ETF, IOZ. We'll go over the ETF fact sheet, including the management fee, how much dividend income it provides, the index the ETF tracks, dividend yield, payment frequency, and the fund's performance. IOZ is an ETF provided by Blackrock, who own and operate the fund. Blackrock are the ones who own the underlying shares in each of the individual companies. So when we buy shares in the ETF, we buy from Blackrock, who continually issue new units in an open-end fund, and not the individual company shares inside the ETF. IOZ tracks the S&P ASX200 index before fees, expenses and tax. IOZ provides low-cost diversified exposure to the largest 200 Australian companies and property trusts listed on the Australian stock market. It offers long-term capital growth along with dividend income and franking credits. It pays distributions, which are dividends from the ETF, 4 times a year with a yield of 3.64%, which would equate to $3,640 of dividend income for every $100,000 invested. It has a management expense ratio of 0.05% per year, so for every $100,000 invested, it will cost $50 per year in fees. And this is automatically subtracted from the ETF unit price, so you won't actually see any fee transactions being taken from your brokerage account. Since IOZ tracks the Australian markets, it is heavily tilted toward banks and mining companies. The largest portion of the fund at 30% is in financials, followed by materials at 22% and healthcare at 10%. Utilities, technology and communication service companies make up the smallest percentage of the fund, under 4% each. The benefit of investing in Australian shares is their historically high dividend yields due to the banking and materials sectors, along with franking credits to eliminate double taxation on company earnings paid out via dividends, with the possibility of getting a tax refund if your tax rate is lower than the corporate tax rate. The bulk of the Australian stock market returns have come from dividend reinvestment, leading to the compounding growth over time. Since inception, IOZ has had an average annualised return of 8%, which includes both capital growth and distributions. Past performance is no guarantee of future performance, but it's a good sign of improving business fundamentals, continually driving each individual stock higher within the ETF. With dividends reinvested, the cumulative return becomes much higher. Reinvesting these dividends creates the larger compounding effect, exponentially increasing our returns the longer we have our money in the fund. This is the approach I take investing for the very long term using ETFs, to one day live off the investment portfolio as passive income through dividends or selling down small parts of the position.